This can be a great episode.
This is going to be awesome. Yeah.
I think Administrivia might only be asking for reviews. Should we keep doing that? Does it sound needy?
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Is it you? Is it you? Is it you? Sit me down, say it straight. Another story on the way. Who got the truth?
Welcome to episode 15 of Acquired, the podcast where we talk about technology acquisitions. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. We'll be talking about the 2013 Salesforce acquisition of ExactTarget. We have with us today Scott Dorsey. Scott was the founder and CEO of ExactTarget, and I actually interned at ExactTarget for a summer when I was in college. And probably worth mentioning, Scott is also my cousin. So super excited to have family on the show. And welcome, Scott.
Hey, thanks, Ben. Really appreciate it. And David, delight to be on the show, and proud to watch how your careers develop, Ben. And glad that you had a little stint at ExactTarget along the way. That's pretty neat.
Super fun. Met a lot of great people there. So
You wouldn't be here today without it.
No, it's true. I think normally we talk about the acquisition history and facts, and David sort of reviews that. But I thought a really cool way of diving into the show today would be to kind of have David do a little bit of review of facts, but kind of go into a Q&A with Scott.
Yeah, that's the plan, since we're lucky enough to have the primary source here sitting with us. So for folks who don't know, ExactTarget was founded by Scott and your co-founders Chris Baggott and Peter McCormick in Indianapolis in December of 2000. So Scott, December of 2000, how did you guys decide to start a tech company? The bubble had just burst. You weren't in Silicon Valley. What was going through your minds?
Exactly, David. It's a great question, and we're a classic, kind of didn't know any better against long odds story, in that we started ExactTarget in December of 2000 under the toughest conditions. The internet bubble had burst. VC funding had really dried up, and we were three first-time software entrepreneurs, starting a tech company in Indianapolis. And actually, none of us had a technical background, so we were against long odds for sure. But we had a real clear vision around what we were trying to accomplish, and it was actually my co-founder, Chris Baggott. And while we're kind of unpacking some family stories here, Chris is actually my brother-in-law. So we both married into this great family from Indianapolis. He's from Pittsburgh and I'm from Chicago. And I had just finished my MBA at Kellogg over at Northwestern, and really studied entrepreneurship and internet business models, and had just come back from our capstone course, which was studying really the Silicon Valley ecosystem and figuring out how to apply that to Chicago and how to apply that to the Midwest. And Chris had this big idea around database marketing and how to apply database marketing principles to the internet. And Chris is one of these just incredible visionaries and evangelists, and he's now done it multiple times, even post ExactTarget, by founding a company called Compendium in the blogging software space, and now he's very deep into food tech and agriculture. But Chris had a real sense that the internet was going to transform marketing, and that email marketing in particular, and permission-based email, was going to be a very powerful way for small businesses to get to know their customers better and be able to build these kind of personalized relationships and be able to deliver relevant content that drove business. And he was right. So he was so passionate about the idea that he really convinced me to kind of quit my day job. I was working for an internet incubator in Chicago called Divine, and we sold the house and had two little ones, and put the family in the car and drove to Indianapolis and said, let's give this a shot.
Wow, that's a pretty crazy. Did you guys try and raise money from Silicon Valley VCs at that point? I know, so you raised some money from friends and family and a few local individuals. Bob Compton, I believe, was your lead investor. But I got to imagine in December of 2000, not many VCs are making any investments, let alone first-time tech entrepreneurs in Indianapolis.
No, that's exactly right, David. We spun our wheels, talking to a lot of different VCs in Indianapolis, Minneapolis. We really didn't head back to the Valley in a meaningful way, but we certainly talked to a lot of VCs in the Midwest with absolutely no luck. And then started talking to angel investors who were also kind of slow to move. So our first round of financing was just a classic friends and family round. We raised about $200,000 from those that loved us and trusted us. And that early investor roster was, my parents and my brother and my father-in-law, and then pretty much all of Chris's neighbors. Chris has just this infectious enthusiasm, and it's not much of an exaggeration to say he went door to door with the PPM in his neighborhood and collected $5,000 checks. And we were so careful, especially with Chris and I being family. We only wanted to raise small amounts of money from family members that if it didn't work out, there'd be no hard feelings and we wouldn't have any discomfort, around the Thanksgiving dinner table. So we scooped up a lot of $5,000 and $10,000 checks and cobbled together the first couple $100,000 in the business. And really cool story is that for those investors that put $5,000 into that seed round and went the distance, and actually a handful of them did, they held the stock all the way through the Salesforce acquisition. That $5,000 became well north of $1 million. Wow. So lots of pools and home renovation projects started popping up in Chris's neighborhood, and we had a lot of happy family members. So that was really our first move. We were a bootstrapped startup. The three of us worked without taking a salary for the first 6 months of the business, and then we were really fortunate to find Bob Compton, and Bob was a very accomplished venture capitalist and tech entrepreneur in his own right. Bob had invested in a company called Software Artistry, which was the first really Indiana software company to go public, and then later was acquired by IBM. And then he was a venture capitalist at CID Equity, and then actually ran one of their investments, Sophomore Danik, and Sophomore Danik sold to Medtronic and was a big exit. So Bob was a very accomplished investor and tech entrepreneur, and he became our lead angel investor and really became my mentor. He was chairman for the first 7 or 8 years of the business. And once Bob put money into the business, then raising capital got a lot easier. We had that stamp of credibility that we really needed.
Huh. And with only $200,000 raised, this was the era before cloud computing. How did you invest that to build the business?
It's a great question, Ben, and it's so different. AWS didn't exist, so we were buying servers. We were racking servers. We were buying networking equipment. We really had to build the infrastructure. And ironically, our first $10,000 went to Lyris, which later turned out to be an email marketing competitor. But Lyris had a server-based solution for sending email at volume, and that was one of our early licensing purchases. So really, most of the money went to building the product and building the early infrastructure. And then this was interesting, and you always have to leverage your timing and your unique assets. And one of our unique assets and an element of the era was that we had a lot of awesome friends and colleagues that were looking for what was next, and a good number of them were with .coms that didn't work out, and we ended up hiring our first sales team as kind of independent contractors, where we'd convince a friend that we had a big vision, this was a neat opportunity, and they would sell for us, and we gave them equity in the company, and they would sell for us, really as an independent contractor, no salary, commission only, and they had to do it all. They had to find the lead, put the pitch deck together, sell the deal, collect the deal, implement the customer, and if they made it all the way through, we paid them a commission. So we actually built this really kind of seasoned sales team early, just on the back of the fact that we had a lot of really good friends that were kind of looking for something that was next in their career. And then once we got funded, they became real employees, and we were able to provide benefits and all that good stuff. But we built a very scalable sales organization before we really could afford to.
How much do you think that sort of original DNA of totally giving all pure commission-based sales to those early sales folks, do you think kind of helped shape the way that organization was built?
Great question, Ben. A huge influence. We, from day one, were a very sales-driven, customer-driven, organization. And, just the nature of the three founders, all sales, marketing leaders, kind of general management background, everybody sold, everybody spent time with customers. And early on, we would describe ourselves as marketers building software for marketers. We had a very, very keen sense for what problem we were solving and what we wanted the product to look like and how we wanted it to function. So that was, product management, V1, was really all driven by the founders. But we created a sales culture early on where the three of us were very aggressive in selling and working with customers. And it's perhaps my very favorite element of software as a service is that if you are a good listener and you work closely with customers, they will reveal your product roadmap for you. And it's really your job to certainly bring your vision and your point of view, but you're really distilling feedback from many, many individuals and organizations, your customers and your prospects in the marketplace. And if you can distill that feedback in the right way and take action upon it, you can build an amazing solution that clients really want. So that was one of our, I think one of our real strong suits was being very close to the customer and being great listeners and really helping them shape our product. But we were incredibly sales driven, and because of that kind of independent network of sales representatives that we built, we were very sales heavy early on. I look back, I did a history of ExactTarget chat a few months ago, and I looked back at one of our early decks. This was even staggering to me, but at the moment where we had 44 employees, we actually had 26 in sales.
Wow.
That's heavy. So we were very, very, very sales driven. And then we also unlocked a channel far earlier than most software companies. We realized that digital agencies could be great partners of ours. They were building websites, they were writing copy and content, but they really didn't have tools for email marketing specifically. And we built a big channel program that allowed these agencies to leverage our tech platform, rebrand it or white label it where they needed to, and build these recurring revenue streams that were advantageous for them. And that allowed us to start reaching into big, Fortune 500 companies like General Mills and Home Depot became clients of ours through their trusted agency at a time when we were still a small and scrappy company. So it helped us kind of punch way above our weight class early on. And that was a big driver of our early success.
On that front, we should say for our listeners too, this is, I think, really our first or one of our first pure enterprise technology companies that we've covered.
Ooh, actually, I'd be curious on Scott's take on saying that.
Well, but I want to come back to that because, and I say that because, as VCs, there's sort of this trope when you're looking at, investments in the enterprise that there's this matrix of, what your target customer is when you're an enterprise software company and who you sell to, and you need it's like a test. You need to have that nailed. It's are you enterprise or are you mid market or are you SMB? Do you sell direct? Do you sell via the channel? And typically you need to have very clear answers to those. But it sounds like from the get go you guys were yes to all of those. Was that deliberate? How did you think about that?
No, great question, David. We were very small business focused, very small business focused. In fact, our first wave of customers were literally restaurants, dry cleaners, pizza shops. We were very SMB and very retail oriented. And the original problem we were trying to solve was that when the retailer, turns their lights on and opens their door in the morning, they often have little visibility into who's walking in the door and who their customers are and how to build, deeper relationships. And that was part of the background that Chris brought to the business. So early on, we were, $1,000 a year subscription and very small business focused. And actually, a good number of the reasons why those early VCs said no is they just couldn't picture that this could become a large business. And then over time, through, I think being crafty and agile and very sales and customer oriented, we started to realize, actually our first wave of expansion was, to grab lots of small businesses at one time, you need to start selling to franchise organizations. So we started evolving to franchise organizations where the franchisor cared a great deal about centralized branding and content, but they wanted to give autonomy and authorship down to the franchisee. So we started to build kind of this parent-child relationship and this kind of enterprise architecture to serve franchise orgs, and that gave us a big boost. Then we started realizing that really every organization in the world is going to need to use email and digital marketing to communicate with their customers, whether you were, a nonprofit or Microsoft on the enterprise side. There really were a common set of needs. And we just built more and more sophisticated technology. And then ironically, we were a Salesforce customer from the inception of our business. So we were students of Salesforce. We really watched how Salesforce built and scaled their business. So we admired that they were, a multi-tenant SaaS platform that served small businesses all the way up to large enterprises. And I just fell in love with the idea that you could essentially build software once and sell and deploy it over and over again, and that you could build features that could be, every feature we ever built had a switchboard. We had an on-off button where we could deploy the software and package it in a really flexible way that was very simple for the small business, or we could turn on all the advanced capabilities for the more sophisticated enterprise, and to have essentially one code base where we have clients, paying $1,000 a year, and clients, we had a lot of 7-figure clients and even some 8-figure clients essentially using the same platform. That's just a remarkable level of scale and flexibility. And there's a lot of tension that comes in, that applies to the organization around segmentation. Who are you building products for? How do you build your services org? What are your support models? But
these are all the things VCs are afraid of, right?
Oh yeah, absolutely. But so we started small, and then we really disrupted the incumbents by kind of inching our way up market. And I think they often underestimated us. But it was that flexibility that was strong, and I wanted to be a part of that democratization of software. I wanted to deliver compelling software to small businesses in an affordable way, and I always felt like our market opportunity would be a lot bigger if we could continue to serve SMB to enterprise. And then the really neat thing is small businesses become big businesses, and marketers leave small companies and go to big companies. So we had a lot of pull through. Actually, one of our largest customers over time was Groupon, and Groupon came into our small business inside sales team when they were barely just getting started, and they were able to scale with us, nearly every step of the way. So there are a lot of neat success stories where that SMB to enterprise range, was a big differentiator for us.
All right, listeners. Now is a great time to talk about a new partner of ours here on Acquired, Legora, the agentic operating system that is redefining how the world's best legal teams work.
Yep, it's sort of obvious that AI is going to completely change the legal industry. I bet most of you listening have dropped a contract into some sort of AI chatbot out there. Legora took that insight and asked the question, what if you really built something with that power from the ground up for the legal industry?
So the founders did exactly what great founders do, operate with obsessive customer focus. They embedded inside a massive law firm for months. They sat with the lawyers just watching how the work really gets done.
And that's how you get features that customers love, like tabular review, where you drop in a folder of hundreds of contracts and it pulls every key term into a grid a lawyer can actually work with. Legora's bet here is interesting. Since it lets each lawyer handle more complexity, any given person can increase the quality of their work and do higher value work. And this means that the pie can grow even as each individual task takes less time.
And they recently launched Legora Agent, offering greater intelligence and performance. The agent lets lawyers set an objective. Then it can handle the planning and the execution and delivery of the final product. Legal teams get to maintain full control and transparency since they're still involved where judgment is required.
And Legora works where you already work. You can use it within Microsoft Word while redlining or drafting. The early Legora numbers essentially speak for themselves. When they have a head-to-head pilot with their top competitor, they win 70% of the time. Legora now has over 100,000 lawyers on the platform from 1,200 legal teams in 50 countries. And crazily, they went from 1 million to 100 million in ARR in about 18 months.
Truly insane numbers. And that is the real test. Plenty of things demo well, but the question is whether a busy associate actually reaches for it during crunch time, or whether a partner trusts it before going into a conversation with a major client. If your legal team wants to check it out, whether you're a law firm or you're in-house at a company, you can learn more at legora.com/acquired and just tell them that Ben and David sent you.
So I'm curious, so you have a few years of bootstrapping, you start really small, dry cleaners, pizza shops, as you're saying, and then, things go well. A couple of years, 4 years later, 2004, you end up raising $10.5 million from Insight. By 2006, you raise another $7 million, and at that point, you're doing, sort of 40-ish million in revenue. On that kind of stair step up, how long did it take to get to, from the individual little guys to the franchisees to up to I would assume by the time you're doing 40-ish million in revenue, you're probably already at the enterprise or starting to hit the enterprise at that point. Were there like specific breakpoints along the way? I'm thinking perhaps Microsoft is one of your biggest customers. How did that conversation start? How did they come into the fold?
Yeah, that's a great question, David. And maybe I'll first start with just kind of going back to that time frame. So in December of 2007, we actually filed to go public. We were 48 million.
There.
Yeah, we were 48 million in revenue. We were profitable, and we were just starting to kind of reach the enterprise space, and we were extraordinarily capital efficient. So the fundraising that you referenced is all accurate, but actually can be a little deceiving because each of those rounds was a mix of primary and secondary capital. So we often had a secondary component to our fundraising to provide founders, employees, and early investors an opportunity to take a little bit of money off the table along the way. And I was so grateful we did that actually because especially because of how we bootstrapped the business and how our three co-founders worked for kind of a very long period of time without paying ourselves. Having an opportunity to take a little bit of money off the table along the way was powerful because it just allowed us to sleep well at night, knowing that we had some level of financial security for our family, and we'd be able to send our kids to college and all those good things. But then it got us hungry, to really want to take the business a distance and make sure we didn't prematurely sell the business. So what was interesting is when we filed in December of 2007, we had only raised $6 million in primary capital, and we had nearly as much on the balance sheet. So we had been extraordinarily capital efficient up to that point. So we filed to go public in December of 2007. The public equity market just fell apart in early 2008, and we actually stayed on file all of 2008 and ultimately decided to pull the IPO in early 2009, and that's a whole nother story I'd be happy to jump into. But I would say it was that time frame where we started reaching up into the enterprise, and the nature of our business was shifting. We started building more professional services capability, and the fundamentals of the business started shifting. And in addition to the equity markets not being very favorable, it actually was a huge blessing for us because it gave us a chance to stay private, bring more capital in the business, and kind of recalibrate toward the enterprise. And it was much easier to do that as a private company.
Yeah, and that's where I wanted to go next here, kind of leading up to. So you finally go public in December of 2007, and this was the days before the Jobs Act, which hard to imagine now that, well, easy because we all lived through it, but your prospectus was out there in the public domain from December of 2007, well, still to this day, but until May of 2009, you were on file, and all your competitors could come read your S1 and see all your financials, and then you ultimately didn't go public then. I assume because of the financial crisis, and in large part, there were no IPOs happening then. What was that like?
It was so difficult. It was so difficult. You're exactly right, David.
All the press, I'm sure, could read everything about you, and you're still a private company, but you have none of the benefits of being a public company, but all the downsides.
That's exactly right. I would commonly say we had all the burden and cost and pressure of being a public company with none of the benefits, zero. Because you're exactly right. This was pre-Jobs Act. And, we had to report every quarter just as if we were a public company. So the silver lining is we had a great training ground of how to set quarterly expectations, how to work with the street, how to work with analysts. We had to do quarterly, earnings calls, with the analysts that would be covering our stock. But it was very, very difficult. And a testament to the strength of our team and our company culture that we kept everybody focused. We kept everybody very positive. And 2008 was just a difficult year for running the business in general, given the economic crisis. Our churn numbers went up because a lot of our small business customers were going out of business. Renewals got tougher, upsells got tougher, new business, there was a lot of price pressure. So, we had a good year in 2008, but it was a very different year, from the prior years of our business. But it was a great learning and growth opportunity for us. And in early 2009, it became evident we were not going to get out. We certainly didn't want to. We didn't need the capital. We didn't want to go public unless we were very confident it was going to be a successful IPO. And then, to my earlier comment, the business really started shifting more to the enterprise. And I also learned a valuable lesson. We were profitable at that time, and the public markets really want to see margin expansion. And it became really evident that if we were to go public, we were going to have to show margin expansion, both gross margin and operating income. And it was going to make it very difficult for us to make the strategic investments in the business that we wanted. We were very passionate about moving beyond email into a pure digital marketing platform. We were ready for international expansion. We were ready to start a couple of our acquisitions, and all of that became a lot easier as a private company. So we pulled our IPO in early 9 in conjunction with a large round of capital led by Battery and Scale, and then later TCV came on board as well. And our internal tagline was better than an IPO. And we really outlined for our employees.
Between that and then a later round you did in 2011, I think you raised more money then in the private markets than you ultimately did in your IPO.
Yeah, we raised $145 million in 2009, and once again there was a large secondary component, but it gave us a war chest to really get aggressive in expanding the business, and we created a vision we called Accelerate 2013, where we became very specific around the company, what we wanted to look like in 2013. We started with the end in mind and then worked our way back. And very counterintuitive. This was the time where, Sequoia sent out their favorite, kind of famous deck around, kind of the
good times.
Yes, good times are over. Almost mandating, 20% headcount reduction across all their portfolio companies. And as all of our competitors were pulling back, we hit the accelerator. We got very aggressive in investing in R&D development, building big sales capacity. Ultimately, we built a sales organization that was 3 or 4 times larger than our nearest competitors. So we kind of hyper invested in the business in 2009 and 10, counting on the fact that when the economy came roaring back, we were going to be the best position to take advantage of it, and that happened. And then we actually rolled into our IPO, which was March of 2012, with just huge momentum. We had accelerating growth rates. We had grown in that 08 timeframe, 08, 09, around 30%, and then we moved up to the 40s, and then we were mid 50s as we kind of rolled into the public markets in early 12. So that hyper investment and that decision to stay private paid big dividends for us.
Yeah, and then talking about accelerating growth, one of the things that always struck me as really unique about ET was how deliberately you expanded the business internationally and using channel partners as the way to grow. I think we haven't really talked about international expansion at all on the show, and it'd be really interesting to kind of hear how you thought about that.
No, be happy to. And you're exactly right, Ben. This was kind of a derivative of our channel and agency program, and that we knew we could get reach into markets that we likely wouldn't be able to address directly through channel partners. And we did the same thing internationally. So we found a partner in the UK, and they spun up essentially an ExactTarget reseller. And we did the same in Australia. And as those great teams and later became friends, they built their business and really scaled it around the ExactTarget platform. When they started to reach some critical mass of customers and employees, we then acquired the business. So it was kind of a low-cost, low-risk way for us to expand internationally before we would have been able to do otherwise, as kind of a small capital-efficient company. And we really validated with these partners that there was a market for our software and our services, outside the United States. And then we started working with multinationals like Nike and Expedia and Microsoft, and it became imperative if we're going to grow those relationships that we had an international presence. So 3 years in a row, we actually acquired every August. First, we acquired our reseller in the UK and used that as a beachhead to expand through Europe. And then the next August, we acquired our reseller in Australia. And then the next August, we acquired a reseller in Sao Paulo, Brazil, and gave us a great reach into that marketplace. So we did 6 acquisitions over the course of ExactTarget history, and 3 were product expansion and 3 were geo expansion.
Cool. Yeah. So you go through this period of kind of from a dead IPO that wasn't going to happen. You pull back, you raise a bunch of money at a time when nobody could raise money. You accelerate the business, come out and you go public in March of 2012, and then it's just a little over a year later that the acquisition happens. That obviously the topic of our show, we want to, and we'll get to category and tech themes and everything else in a minute. But but I want to spend a little bit of time. We were talking with Scott before the show. One of the things we love to do on Acquired is dig into these legal court cases and SEC documents and all sorts of stuff. And luckily, in ExactTarget's case, I don't think there were any major court cases. But one of the things that happens when a public company is acquired is you're required, and this will be coming out for LinkedIn soon. I can't wait to dive in. You're required to disclose to the SEC the play-by-play of exactly how the acquisition happened. And so that we'll link to it in the show notes. It's this amazing document about how the ExactTarget acquisition happened. And I'd love to just, ask you to talk a little bit about that process of, how it started and again, all of it's documented publicly. Like there were 3 other bidders that we can't talk about their identities. They're referred to as Party A, Party B, and Party C in the document. But multiple offers going back and forth. I mean, that must have been such a stressful time for you. How did you navigate through it?
It was incredible. It was an incredible learning experience, and exhilarating and nerve-wracking at the same time, for sure. So we had been a public company for 5 quarters, and life was good. We had a great time. Our IPO was super successful. We came out of the New York Stock Exchange at north of $1 billion valuation, and our IPO was heavily oversubscribed, and we felt like we had all the right investors supporting us from day one. And all that learning that happened in 2008 and 2009, we're able to really apply to the S1 and filing process and IPO, and how to pick the right banks and the right analysts. And we had an amazing time going public, and really loved it. And then 5 quarters as a public company, more of the same. We kind of met and exceeded plan every quarter. We were really embraced by Wall Street and had a great investor base. We had completed 2 acquisitions, one called iGo Digital in the predictive analytics space, and a second Pardot in the B2B marketing automation. And life was great. We were very happy, as an independent public company, and we were growing, north of 40% year over year. Wow. What started to really happen, across the, kind of software ecosystem is that, marketing cloud solutions started really garnering more attention. And I would say really the largest, probably 5 or 6 software companies in the world, were really all shifting to the cloud and publicly stating an intent to go a lot deeper into marketing. So that started happening in a big way. And for us at ExactTarget, a big part of our strategy had been to build a very open platform, robust APIs, and lots of integrated partnerships. So our premise was that marketers need one place to store all the data they have on their customers, and then to use that data to drive more personalized and relevant communications and relationships. So even literally before the App Exchange even existed, we integrated into Salesforce, and we integrated into Microsoft Dynamics, and we had great relationships with Adobe and Omniture and kind of many others, across the industry. So it was very logical that we were attending shows and conferences and co-selling and co-marketing kind of with all these companies. But Salesforce, we've had this really rich relationship with, from being a customer to being an integrated partner to doing lots of things together in the market. And, we got to know Mark and the team. And, Salesforce had made a big push into marketing with the Radian6 and Buddy Media acquisitions, and really, had a social first strategy. And over time, it just became apparent that their customers wanted more, that social was an important channel, but they really wanted a multi-channel platform. They wanted greater data capabilities, and they wanted a platform that was not only oriented for B2B customers, but also B2C. So we always had a close relationship with Salesforce, and would always kind of share product roadmaps and vision and direction. And it just became apparent they were going to make a bigger investment in marketing, and knocked on our door and said, hey, we'd like to collaborate and take a closer look at kind of joining forces. And you're absolutely right, David. When you're a public company and you get that kind of inbound inquiry, the level of governance and process is at a very different level.
Yeah, and I'm curious, and really for our listeners, we'll link to this document. You should read it. It's like a legalese version of like high drama, of like Shakespearean drama. But did somebody hand you a playbook and be like, okay, here's what you do in this situation, or were you guys, figuring it out as you went along?
Clearly, it was a first-time experience for me, but fortunately, we had an excellent, set of advisors and board members that had quite a bit of experience, in this area, to make sure that we really followed the right process and did what was ultimately in the best interest of our shareholders. And for me, as founder and CEO, it certainly can be, kind of an emotional and even a bittersweet process. And I had hoped that the premium we were offered would be, so substantial that it was really an excellent outcome, for our shareholders and for our employees. And then I'd really hope that we we ended up with an acquirer that was very strategic and would continue to invest in the business, and Salesforce became that, and a whole lot more. So the process was amazing. It was fast and exhilarating, and certainly had a lot of pressure associated with it. But I was very, very comfortable that this was the best decision for our shareholders and for our employees and all of our constituents. And now that we're able to, see what's transpired over the last 3 years, I have 100% confidence that this was a huge win for Salesforce and for ExactTarget and everybody involved with the company along the way.
Yeah, I'm really curious. You guys sold for about a 50% premium over what you had been trading at publicly. There's got to be a bunch of offers sort of coming in from investment bankers or perhaps even CEOs calling you and saying, hey, I think this might work out. What number do you start actually paying attention and listening? Like, when do you form the subcommittee?
And we should say too, the acquisition happened in June of 2013. $2.5 billion, $33.75 a share. And your IPO price, I believe, was $19 just over a year before. So,
and I think trading at 22 or so day before.
Yeah, that's about right. Our IPO price was 19. We came out at 23 and a nickel. And then, largely traded, in the 20s, and we're kind of in the low 20s, when Salesforce, first put their first offer of $26 a share in front of us. And I'll tell you, Ben, it was less about even coming up with a number that was interesting. We were really just focused on making sure that when you get that, first level of inbound interest, that we take it seriously and really handle the process in a way that's above reproach, and that we're, kind of following every step you need to as a public company, and let the process run, and then ultimately let the subcommittee and the board make the best decision at the end of the process.
And it helps too. I think you guys during the negotiation process released you beat Q1 earnings and upped the guidance, and that's always a good thing to do. It's as you were saying, too, about when you pulled the IPO the first time, and then went out, raised all the money, and then went out afterwards with the accelerating growth, great acquisitions happen when companies get bought, not sold. When you had a bright future ahead of you and things were going great and didn't need anybody, that's the...
No, that's exactly right. And you maximize value, when you are operating from a position of strength and you have multiple parties that are really interested in either making a venture investment or ultimately acquiring the company. And fortunately, we had that, we had that in a big way. And we just fit so beautifully into Salesforce. They had a big vision around the marketing cloud. We were a perfect complement to the two acquisitions they had already made. And we really brought this, data architecture that was very consumer-oriented to the table. So we give Salesforce a big entree into the B2C side of the industry. We brought, this multi-channel marketing platform where by that time we'd expanded, beyond email into mobile and social and web analytics. We had a really broad, kind of digital multi-channel platform. We were, the largest and the fastest growing marketing software company really in the world, and we were able to fill a big gap for them. And then silver lining was that we had recently acquired Pardot, and Pardot was this just gem of a company in Atlanta that we acquired for right around $100 million. And they were a B2B marketing automation player tightly integrated into Salesforce. So Salesforce, not only was able to get all the benefits that ExactTarget brought to the table, but Pardot was a great snap-in that put Salesforce in a position where they could compete with Eloqua and Marketo and other players in that kind of that slice of the industry as well.
Cool.
All right, listeners, now is a great time to tell you about a longtime friend of the show, Vanta. AI has scrambled the whole security picture. It used to be that you proved that you were secure once a year, an audit or a static PDF, then everyone would nod and you're done. But in an AI-first world, that doesn't hold up anymore.
Yep, your risk surface changes every week now. A vendor turns on an AI feature or someone writes in a new model without telling IT, and your posture is different than it was last week, let alone at your last audit. Vanta's own research found that around 70% of companies have this quote-unquote shadow AI running with no security review at all.
Right. And that's where Vanta comes in. They're the leading agentic trust platform, meaning they've built the thing that closes the gap. And the way that they close that gap is Vanta Agent. Think of it as a GRC engineer, that's governance, risk, and compliance, except that it's software and it doesn't sleep. It finds the issues, drafts the fixes, and cuts the time that you'd spend on vendor assessments in half.
In half, which is exactly why more than 16,000 companies today run on Vanta. Companies like Ramp, Cursor, and Snowflake all stay audit ready and catch the risks that crop up between audits across every vendor, every AI tool, the whole environment.
And that's the real value. Trust has to be continuous now, which is why Vanta automates your security, your compliance, and the work to earn and prove trust. We're huge fans of Vanta over here, and literally hundreds of acquired listeners have become Vanta customers at their companies over the years. So you can get $1,000 off Vanta at vanta.com/acquired. That's VANTA.com/acquired for $1,000 off. And just tell them that Ben and David sent you.
Well, I think this is it's about time we move to our next section of acquisition category. And what we'll kind of do is David and I will kind of make our picks between people, technology, product, business line, or other. And then Scott would love to get your take.
Encompassing other.
Yeah.
We picked it once or twice. But,
yeah, it's always kind of cheap when we do.
Well, I think for me, it's Scott, obviously your word is most important here, but clearly this is a business line acquisition for Salesforce, going from, and it's interesting, this is going to go into my tech theme in a minute, but, having been selling into the sales organization for so long and developed these huge accounts and big scale business that Salesforce had to pick up ExactTarget, and as you were mentioning, Pardot and everything else along with it, to now be able to sell into the CMO and the marketing side was clearly a business line and a great one for them.
Yeah, I mean, I've nothing to disagree with there. I mean, ExactTarget clearly had it was not just a product, but a suite of products. I think when I was finishing up my tenure there, we were launching the digital marketing hub, and that included SMS and email marketing, microsites. We had social with CoTweet, and it became clear that there was their own ExactTarget had channel to a lot of different customers that then Salesforce could expand into, but really a whole suite of products to add to Salesforce's repertoire too. And if it weren't more clear that this is a business line, Salesforce actually still calls this the Salesforce Marketing Cloud business line that they break out into results. And Scott, you ran it when you came there, right?
Correct. I would absolutely agree, guys. There's no question that we brought a tremendous group of people and talent and culture to Salesforce, and a lot of really unique and proprietary technology. But I would agree, if you had to classify the acquisition into a category, I would call it business line, because we just fit so beautifully into their marketing cloud strategy and brought a sizable amount of recurring revenue. We were $300 million in recurring revenue, moving to $400, and for Salesforce at their size and their growth velocity, and now you see it with Demandware. They have to make large acquisitions, that are meaningful, that actually are relevant and can contribute to that top line growth. And we were able to do that in a big way. And it's made me really proud that, Mark, on a number of occasions with Jim Cramer on Mad Money and other places, has said that ExactTarget's been the most successful acquisition that Salesforce has ever completed. And I believe that to be true. It's just gone remarkably well. And the leaders that were on my team that are now leading, kind of big functional areas within Salesforce and the Marketing Cloud, they're happy and having a tremendous amount of success and really growing the business in a big way and committing to Indianapolis, which is really, really cool. Salesforce just recently announced that in addition to the 1,400 employees they have in downtown Indy, they're going to add 800 new positions over the next few years. Wow. And then I don't know if you've heard this, Ben, but the tallest building in Indiana is the Chase Tower. Salesforce is going to consolidate and move employees into that tower, and it's actually going to be renamed the Salesforce Tower. So to have the
thing about towers too.
Oh yes, no, absolutely. Mark likes his towers. Mark and the team they love their towers, but it's going to be so fantastic for our tech community that the tallest building in the city and the state is actually a tech building. So it's going to be a big boost and accelerator to our tech community, which I'm very happy about.
Well, and I always remember too that there's so many unique things about ExactTarget for the region. There's this big drumbeat from I think maybe your first or second office that it was about being an urban company. and that people needed to, we were in Monument Circle, which was like this incredibly cool, historic, like center of downtown, big statue. ExactTarget had a building with this cool roof deck that looked out over it. And I remember thinking, well, I never want to work in an office park again. And I think that like a lot of ExactTarget employees got super spoiled in that way.
No, that's exactly right, Ben. Our real estate strategy was to really build around this urban core and build a campus and a work environment that was super appealing, really to the millennial, the younger generation. And it's been really fun over the last decade. Downtown Indianapolis has had this huge resurgence of housing and amazing, restaurants and kind of a lot of arts and culture and sports. And ExactTarget, has been a part of that fabric of downtown Indianapolis. And I really felt that to build, a high growth category leading company in a market like Indianapolis, we had to be in the urban core to really take advantage of just the energy, the vitality, the ability to recruit, top-notch people from all over the country. And then even to bring in, partners and VCs and customers that could fly into Indianapolis and, take a 15, 20-minute cab ride to downtown Indy and then be able to just enjoy all the benefits of that downtown setting has. And that's been neat. And I'll tell you, one of the neat legacy elements of ExactTarget is for years we've worked on getting a nonstop flight in place from Indianapolis to San Francisco, and not having it's been a real barrier. Our West Coast investors, have to jump through lots of hoops to make it into Indy for a board meeting, and it makes just fundraising for all companies here in Indy more difficult. And right around the time of the acquisition, we actually got it done with United Airlines, and have had a nonstop flight back and forth to San Francisco, which might seem trivial, but it's actually been a game changer for our tech community, and Salesforce has appreciated it as well.
No, I totally believe it. I think a lot of credence is paid to Seattle's proximity to San Francisco as a competitive advantage in fundraising and starting a company in general. And I think that kind of quick direct flight has just a tremendous amount to do with that. It's
so true. And the same is happening at Salt Lake City. Salt Lake is this amazing tech ecosystem, with Omniture and Adobe, and now you've got, almost a dozen, I would say, kind of unicorn level valuations. And so much of that is, Salt Lake and Park City are kind of a wonderful place to be, but it's such a short hop away from Silicon Valley that you're able to raise capital and get those investors really engaged in the business.
Yeah. Moving to the next section, what would have happened otherwise is sort of two alternate futures here. And I kind of want to pose both questions to you. One is, do you think ExactTarget would have made sense with any other acquirer? And then two, ExactTarget competed against Responsys and many other companies that started as email marketing solutions for a long time. Do you think there was anyone besides ExactTarget that could have made sense at Salesforce?
I think yes to both questions. We certainly could have fit in well with a number of kind of the other largest software companies in the world that have been focused on going a lot deeper into marketing tech and saw it as a big growth area. And then there's no question, that Salesforce looked at lots of different players, over the course of time to potentially acquire. And one element that's interesting when you go through that evaluation process as a public company and really try to make the best decision for your shareholders is you really have to do a lot of financial modeling and a lot of thinking about what does life as an independent company look like. And we ultimately did come to the conclusion that being a part of Salesforce was a better outcome, higher probability outcome for our employees, for our shareholders. But there are a number of different ways that our future, could have played out. But I was very, very happy the way it played out. And I'll tell you, the other interesting dimension is, a public company, we would get an enormous amount of pressure around email. When is the end of email coming, and these new channels are going to cannibalize email. Oh my gosh, it's just it's kind of like if I had a nickel for every time I answered that question. But it was just a heavy theme, and even sometimes I'd say a cloud over our company, where we were thought of as such an email-centric company that even as we expanded around the world and expanded into all these other adjacent technologies that you referenced, Ben, we were still thought of as an email company. And I think often didn't get credit for being a broad, multi-channel, omni-channel platform. But email was such a powerhouse for marketers that line of business just kept booming, and our other lines were growing, but they could never even get close, to the email side of the business, because it's just the most powerful tool that a marketer has. And as e-commerce has exploded with growth, emails become even more relevant.
Yeah. I'm curious, when you're forecasting, what does life look like as an independent company? I mean, let's say you could continue to grow 40% year over year indefinitely, or at least to the top of some S
Easy
curve.
to say on paper, hard to do in practice.
That's right. Gets tougher with the law of big numbers.
Yeah. So at what point do you, one, factor in the top of the S curve, and then two, how many years out, what do you look at as like sort of the payback period of that premium, and say like, well, they're giving us 50% premium and we don't think that we will reach that market cap for 20 years and we're only looking at a 10-year time horizon or something like that?
Yeah, I'll tell you, that's where, that's really where the bankers and advisors and, kind of independent committee come in, because they had a lot of expertise in how to build those financial models and what time horizon, makes the most sense in order to kind of predict your independent path versus joining forces with another. So I probably can't provide a lot more detail than that, but you're exactly right, Ben. That's exactly the process that you go through. That's right.
Yeah. I'm curious, before we move on from this, and this also bleeds into my tech theme, you don't have to say whether you considered it or not, but do you think, looking back, most of the big data-driven marketing companies of that generation, ExactTarget being one of, if not the leader, got really big, were growing really fast on a great trajectory, but then they all got swallowed up by other big enterprise companies, whether it's Oracle and Eloqua, or ExactTarget and Salesforce, or do you think there was any way that, if maybe there had been consolidation among the companies into, could there have been a giant, there's so few giant enterprise software companies, could one have been built in the marketing category?
Yeah, that's a great question. I think why it didn't happen is overlapping functionality. That when you take a look at, and there were certainly a lot of conversations that ensued along the way, could you stack together, some of these kind of large marketing tech companies to become something bigger and something more meaningful? And where it starts to run afoul or kind of collapse is that you just have a lot of duplication of functionality. So, when Omniture, got kind of pulled into Adobe early, there certainly could have been a fit between, let's say, email and digital marketing channels and analytics. That would have been a logical connection point, but they kind of got pulled into Adobe early. But when you looked at, us and Responsys and some of the B2B marketing automation companies, you often had, kind of a lot of redundant functionality. But we were headed down that path ourselves, and that's really why the Pardot acquisition made sense, and we kind of kept moving deeper into data and analytics and the web, and really trying to build out that robust platform to make all these channels work together. And what's really interesting is the big product we built that stitched it all together is a product called Journey Builder, and Salesforce has really embraced that Journey Builder platform and is applying it even across different clouds within Salesforce and using it in lots of unique ways.
All right, listeners, now is a great time to thank our longtime friend of the show, ServiceNow. If you are running a large enterprise, AI agents are likely spread across every team, and deploying them is no longer the hard part.
Yeah. The hard part is knowing what permissions they have, what employees are using them for, or what decisions AI is making. AI security for an enterprise at scale is not a small concern. Like, the risks are real.
Exactly. And the challenge with AI is governing it, securing it, measuring it, and making sure that it actually delivers value. That is why ServiceNow built the AI Control Tower.
Yep. AI Control Tower gives enterprises a single place to see, manage, govern, and optimize AI across the entire business. And it works with any AI, not just theirs. Every device on your network, every permission across every system, every AI agent visible and secure in one place.
And ServiceNow can do this because they've spent more than 20 years building the operational backbone of the enterprise, the workflows, governance, approvals, security controls, and institutional knowledge that power how work actually gets done across IT, HR, customer service, finance, and security.
ServiceNow already runs more than 100 billion workflows annually and trillions of transactions for more than 85% of the Fortune 500. So when companies need a place to govern AI at enterprise scale, they're building on a platform at the center of how their business already operates.
And in a future that isn't going to be one AI, it's going to be thousands of AI agents working across every function of the company. But the question is, who's managing them all?
So if you're trying to turn AI ambition into real business outcomes and make it work safely, securely, at scale, go check out servicenow.com/acquired and tell them that Ben and David sent you.
David, do you have anything before we go into tech trends?
No, I don't think so. The only comment, just Scott, on what you were saying is it's interesting. You're seeing so many startups now that are emerging that are next generation marketing automation, but they're all taking the approach that you said of marrying it up with data and analytics. I'm thinking anything from Mixpanel and Segment is part of this ecosystem in a different way, but so many Customer.io in Portland, Intercom. It's funny, they're taking exactly the approach that you're saying, Scott.
No, it's fun. It's fun to see it evolve. One other topic that you asked me about, David, but I think I jumped into another category, but it's kind of a fun story I'd love to tell you about. It's just the nature of our Microsoft relationship. Do you mind if I just touch on that real quick?
I would love that.
Yes, that was a really fun story. So we really became the largest cloud company running on Microsoft technology. We were early users of SQL and .NET, and really everything we built was on the Microsoft framework. And we pushed Microsoft technology, I think, to the edge, as we were building a super transactionally intensive, multi-tenant platform. But through that, we really built this wonderful relationship, and then we started integrating into Microsoft Dynamics and had a really nice relationship there. And then ultimately, Microsoft became a customer. And it's a really fun story. Microsoft had an internal email platform called Pens. That really kind of powered marketing automation and email marketing specifically for Microsoft business units. And the internal solution was not well liked across Microsoft. So when we were fortunate to land Microsoft and really go through our adoption, we built like an 18 to 24 month implementation period where we would be onboarding different business units of Microsoft onto ExactTarget and offboarding them on the internal system of Pens, and we set a joint goal with the. It was an acronym for I'm sure personalized email something notification system.
You
maybe
had to beat it if you're competing against Pens.
That's right. Exactly. So we actually set a goal with the Microsoft implementation team, and they were incredible to work with. That when we got to the end of the implementation and we're literally able to turn the lights off on Pens, retire this internal system that was not well liked across the enterprise, that we'd have a celebration, we'd have a party, and we did. We actually on the Microsoft campus had a huge tent that was erected in an event that was just catered to the fullest. I mean, beautiful wine, beer, food, and the Microsoft team, they had to get fire marshal approval, but they actually pulled the servers that were running Pens out of Microsoft data centers and brought them to the party, and we sledgehammered them. We all strapped on goggles and just beat the tar out of these servers.
And it was office space.
It seriously was. It was total office space. It was just like a spectacular way to retire their internal system. It was a blast.
Wow, that couldn't be like a better segue into what technology themes does this illustrate for you? And that's like a very physical, visceral manifestation of the one that I want to touch on, and that's businesses using software as a service to outsource anything that's not their core competency. I mean, this keeps coming up in episodes over and over again, where businesses now, with the advent of cloud computing and the general cost of starting a company going down, companies operate using tens of other companies' infrastructure and software, often even starting at a free tier or on some kind of freemium pricing structure. And it's different at that sort of scale where they're actually migrating from something they built in-house. But I kind of wanted to open it up to you, since what you do at High Alpha is start these new software as a service companies. How do you identify where are the sort of holes where we can take something that a whole bunch of companies are doing and do it on one platform, and then they can all just pay us to use our platform?
No, it's an exciting part of High Alpha. So, High Alpha, we're a venture studio. We started a year ago, and we're a venture studio focused on starting new cloud companies. And we actually have two sides to High Alpha. High Alpha Studio is our startup studio, and we've signed up to start 8 to 10 new companies over the next 3 to 4 years. And then High Alpha Capital is our kind of second arm, and that's a venture fund that is utilized to fund our own companies when they're ready to reach scale, and then also fund other great SaaS entrepreneurs around the country. So you're right, Ben. We spent a lot of time on just ideation, looking for unmet needs, within the enterprise cloud space. And we do that through our own ideas. We do that through entrepreneurs that approach us. We spend a lot of time with corporate innovation groups and universities and just, tech visionaries that, have a sense for where the market's going. And this whole notion that every employer is a buyer of software is something radically different. You kind of think back to, the client server days, pre-cloud, and, tech spending and buying was tightly controlled, tightly controlled by the CIO and the IT department. And then, with the advent of cloud, it starts to kind of open up to different, business unit or business line owners can make decisions within a framework. And now we're in an era where every employee is a buyer, with freemium and an employee credit card, you can spin up Slack channels and lots of other solutions. And it's creating lots of opportunity, but it's also creating quite a few unintended consequences. So you'll get a kick out of this. We actually have started a new business. We haven't announced it yet. That essentially is a SaaS platform for managing SaaS. Managing SaaS applications. It really is, and it's targeted at the chaos and kind of the overcrowding of SaaS spend. It's a huge problem, and our MVP is about ready to go live with our first group of pilot customers. But it brings together SaaS spend, SaaS utilization, and then user sentiment, user feedback. So it brings those three variables into one platform, so organizations can, at a minimum, actually understand what they're using. What have they paid for? What's being utilized across the enterprise? What if maybe they paid for but isn't being utilized? Where do they have overlapping products and platforms? Where's there maybe something cool happening? Like where's there innovation happening within like one group or department that should be thought about across that organization? So that's kind of a cool company that we're excited about to help organizations kind of get their arms around how their business is using SaaS and use it in the most optimized way.
So the tech theme that I've been referencing a bunch, and this is another perfect lead in, is there's been this sort of historically in the enterprise space, which again, we haven't talked as much about on the show. There's been there kind of been sort of four-ish giants, right? Like there's Microsoft, there's SAP, there's Oracle, and then there's Salesforce, which has emerged as sort of the most recently as one of these giants. And there's this concept of like account control, and like there are lots of startups in the space, but ultimately those four companies are by far the biggest, and they have the account control with the CIOs and increasingly CMOs and heads of sales and CEOs, where they can push all sorts of products through their channel. And ExactTarget, as we talked about being a business line acquisition, was a perfect fit with Salesforce as one of their first forays into a new product, sending through their guerrilla channel, or guerrilla-sized channel. Do you think that's, how do you react to that? And or one of the main theses I think of SaaS enterprise investors is that with SaaS, like that's changing, right? Like people can buy stuff freemium, like individual employees, and account control is being eroded. I don't know. How do you think about that? Being on both sides now.
I definitely see both. I definitely see both sides of it, and you're totally spot on, David. It's one of the big reasons why the ExactTarget acquisition's been successful is that Salesforce just has these amazing executive level relationships with the biggest companies around the world, and they know Salesforce, they trust them, they want to buy more products, they want to buy more products that are tightly integrated. And when you look at the Salesforce Marketing Cloud numbers, they're booming, and they're really booming because they have all those trusted CEO and CIO relationships, and then Mark and the team, they're just incredible, innovators and amazing at executing, scaling the business. So that's real. There's no question about that. However, there's still plenty of opportunity for new innovation and new entrants, and the innovator's dilemma of companies coming up with new ideas and new concepts and software that's lighter and more flexible and more mobile friendly and more consumer like. There's no shortage of room, I think, for innovation and for new companies to find their groove.
And that you don't need your CIO to approve to buy it.
You don't. That's exactly right.
Which honestly, you're talking about ideation and getting ideas for new companies and getting your first customer. Obviously, something near and dear to my heart at Pioneer Square Labs. And as someone that is often going out and transitioning from the customer development to getting your first customer and taking the people that you were talking to about what are your needs and saying, cool, we built this, will you pay for it? It's become extremely easy to do that when you have an advocate in the organization who, for, like, you're going to charge less than $1,000 for your product. So they just can use their credit card and you don't have to go through the CIO. So it's opened this whole new wave for us of the ability to land your first customer in a much faster time frame.
Absolutely. No, that's exactly right. And then all these great cloud platforms where you can really quickly, right, build technology, build MVPs, get it to market, and really see if you've got product market fit and you've got something that can be viable. And that's what's so fun, I think, Ben, about what we're both doing in coming up with new ideas and launching new companies is you can go from idea to MVP and proof of concept really, really quickly.
Yeah. All right, we're going to move on to what was formerly the last part of our show. I think we have a couple cool sections after, but grading the acquisition. And Scott, you can choose to participate in this or not. I feel like you might be a little bit biased, but this is obviously an incredibly successful acquisition. I mean, you hear Mark preach it to the world time and time again, and some of the biggest stages he's ever on. Obviously, a success. We've given A's to things that have like ridiculous multiples. I mean, you look at what Instagram did at Facebook, or you look at Pixar's sort of reverse integration or reverse acquisition of Disney Pictures, Disney Animation. I mean, those are our A's. So I guess where I'm going to land on this is an A- for ExactTarget. I
think I'm similar. We've talked about all the reasons why this is a great outcome. One thing that we actually didn't quote, it's funny, we're not super quantitative on this show, even though we're about, acquisitions. So we went through this whole episode. We didn't talk once about your revenue, but some numbers I want to throw out. When the ExactTarget in 2012, which was the final year, a full year of being a standalone company, I believe you had about $294 million in revenue. And in Salesforce's fiscal 2016, which ended January 31st, 2016, so essentially the calendar year 2015, the Marketing Cloud division did $654 million in revenue. So over twice as much in less than 3 years. So that's a pretty great outcome. I think, and speaks to the power of this. There are many product things that I'm sure that Salesforce has done with the acquisition and bolted on many things, but also just the power of these enterprise relationships that they have. So I think this was a great deal. And I'm also gonna, when I think about Instagram, it went from a $1 billion acquisition price to $3 billion in revenue in like 3 years, and that's all right. I'm also A-, but I'm on the fence here. Scott, any comments?
You guys are tough graders. You guys are really, you'd be like that professor that's really difficult, incredibly stingy about giving away an A. So life is
not fair. So
I know. Instagram is the bar. That's a high bar. Yeah, there's no question I'm biased, but I think I'd give you a really fair grade, and I definitely give a full A. No minus. I'd go with the full A, and I'll tell you the reason is that this was an extraordinary outcome. For ExactTarget, you think about 3 first-time software entrepreneurs, starting a software company in Indianapolis, with very humble expectations.
Nobody thought this was going to happen, right?
Inconceivable.
You guys are the definition of underdogs.
Inconceivable that we would ultimately sell the business for $2.5 billion. And what I'm so grateful for is that every employee who was a part of ExactTarget had equity in the company, and this was really a meaningful outcome for our employees. Not only just the kind of experience of a lifetime and being a part of this powerful culture we called Orange, but there was a financial outcome that was meaningful. And the neat thing is that, at $33.75 a share, every person who ever invested in ExactTarget, from friends and family to venture rounds to public investors, made money. So I smile from ear to ear just thinking about what an incredible outcome this was for everyone at ExactTarget. And then the neat thing, and David, I'm glad you referenced the numbers, is that integration is remarkably difficult. It is so difficult to acquire companies, integrate them effectively. And when you look at Salesforce, this was the largest acquisition they had done, first time they'd ever acquired a public company, and to see the kind of results that have been produced. And I just know how delighted Mark and the team have been about the performance of the business. I give it an A on both sides, the Salesforce side and the ExactTarget side.
As an entrepreneur, you have to love your company, right? Like if you don't, who else would?
Oh, absolutely. Absolutely. That's right.
Well, let's move on to some fun we have at the end of the episode. It's a section called the Carve Out, and this is where we talk about something that's in pop culture or media that we read or watched or stumbled upon, or a product that we love. Really anything that really tickled our fancy in the last couple weeks. And I'll start with mine. I'm a big fan of The Talk Show. It is a podcast done by John Gruber of Daring Fireball that mostly covers Apple. And John does a live show every year at WWDC, the biggest Apple conference. And this year, his guests are normally friends of his or other people sort of in the Apple journalism space. And out walks, Craig Federighi and Phil Schiller, the senior VP of marketing and the senior VP of software or just engineering all up. Anyway, just like an unbelievable, candid interview with two guys that have great personalities on stage. And you normally only see these people in the extremely rehearsed, very, very perfectly timed and executed Apple keynotes, and getting them off the cuff it's just so fun if you're a fan of Apple or just like a fan of technology and how these businesses run in general, to get that sort of candid look at these guys. Yeah,
mine is a great book that I'm almost done reading, but have been enjoying immensely. This was recommended. I saw this as a recommendation. I went to Y Combinator's startup school in 2013, I believe, either 2012 or 2013, and Jack Dorsey spoke there, and he recommended it as a book. And it's been on my list, ever since, and I just finally got around to reading it. It's a book called The Score Takes Care of Itself, and it's by Bill Walsh, who was the legendary, unfortunately late coach of the 49ers during their amazing dynasty in the 90s, and which I remember, growing up and watching, Joe Montana and Jerry Rice and Steve Young, and but the book is just, it's about his, kind of philosophy and lessons on leadership. And he's such an amazing guy. Like, he's not you think of like a football coach in that era, and it's like, super, hard and yelling and screaming. Like, that's not his style at all. It's just this commitment to excellence. And that's all that matters. And all the other stuff is just show. And, but anyway, there's lots of good gems in the book. We'll link to it in the show notes.
I'll have to check it out. That's very fun. I love the carve-out feature here, guys. This is kind of fun.
Thanks.
And David, I should clarify, Jack Dorsey is no relation. I mean, although I've got lots of family connections here on the show, Jack and I are not related to one another, although that'd be kind of fun. So my carve-out was a month ago. I was flipping channels trying to find, I think, probably an NBA playoff game, and flipped over to ESPN and caught the end of the National Spelling Bee, the Scripps National Spelling Bee. And it was phenomenal. The two finalists were an 11-year-old and a 13-year-old who were just extraordinary at their ability, obviously, to spell very difficult words and handle a tremendous amount of pressure. And they ultimately tied in the end. And this, the 13-year-old had an older sibling that had won previously, and the 11-year-old was a fifth grader who was the youngest kind of finalist and champion ever. And watching those two operate was incredible. And to me, and I'll tell you two little stories. One, it's just quite exceptional, I think, how young people are developing so quickly. And when we look across our businesses at interns or contributions new college graduates can make, they are able to contribute to businesses in a way today that never existed in the past. And watching these two kind of young students compete was really incredible. And then one of my favorite parts is that each of the finalists had to share their favorite word, which I would definitely have a difficult time spelling any of them, probably even pronouncing one of them. But one of them that stuck with me was indefatigable. And for whatever, great word, which really means tireless persistence, to be indefatigable. And as I'm working with all these early stage startups, to me, that's like the number one characteristic for a CEO or a founding team, is that they have this tireless persistence, and they have such a burning fire inside them to succeed and to solve a big problem and make a difference in the world, that you just know they're going to be successful.
That's great.
Totally agree.
David, do you want to table follow-ups until next time? We're running a little long here.
Yeah, well, maybe I'll just do one real quick, which, because we've mentioned it a few times on this show,
Sure.
Instagram reported latest user numbers this week, or Facebook reported Instagram's latest user numbers this week. Pretty incredible. They passed 500 million registered users, 300 million daily active users. Think about that ratio. 3 out of 5 registered users on Instagram use it every single day.
Wow, that's impressive.
That's engagement.
Instagram was one of our very first shows, and like I said, it's our canonical A, but especially with Snapchat and everything going on, there's all these existential questions, and that business just continues to perform at an amazing level. So,
Indeed.
thank you, Scott.
All right, listeners, now is a great time to talk about one of our favorite companies, StatSig.
Yes, longtime acquired partner. There is a reason why the best product teams at companies like OpenAI and Notion, Atlassian, Figma, Rippling, Brex, and more rely on StatSig, whether they are iterating on their core product features or shipping AI-powered experiences at scale.
Yep. In the crazy speed of today's AI world, shipping fast is just table stakes now. It's basically trivial to build and deploy your app constantly. The real advantage is how quickly you learn what changes actually created value for customers and how fast you can use that signal to guide what you ship next. Whether it's a feature tweak, a pricing change, a performance improvement, or an AI update like a model change or prompt adjustment, they're not relying on instinct. They're measuring what actually moved engagement, retention, and ultimately revenue. And as more teams build with AI, that learning loop becomes even more important. Building with LLMs introduces non-determinism into your product experience. The same input doesn't always produce the same output, and behavior can shift in subtle ways in real-world use.
So doing offline evals will give you part of the picture, but you can really only understand the impact once your product is live with real users, and then you can measure how their behavior actually changes. It's very different than the way that you would ship features in a pre-AI world where you knew exactly what the software was going to do in production.
Yeah, exactly.
So this is where StatSig comes in. It brings experimentation, feature flags, and product analytics into one unified system so teams can ship safely, test rigorously, and directly link what they changed to how users actually behaved. The result is a tighter feedback loop and learning that compounds over time, so you don't just ship more, you ship better.
So if you want to make learning your competitive advantage, whether you're building new AI experiences or just evolving your existing core product, go to statsig.com/acquired to get started.
Yeah, hey, just to kind of close down the show, anyone listening out there, thanks so much. Tell your friends, review us on iTunes, share it on Twitter, Facebook, whatever you like to do. Snap about us if that's your thing. And Scott, how can our audience find you?
At Scott Dorsey on Twitter, and then highalpha.com. You can learn more about the new venture that we're building here in Indianapolis.
Awesome. Well, thank you so much.
Yeah, thanks so much, guys. Really enjoyed it. Thanks, Ben. Thanks, David.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Huh?